Okay, the week ahead. The market has spent an inordinate amount of time talking about the Fed meeting coming up next week. I've seen two rallies in the market, and they attribute those rallies to the Fed meeting and the rate cut. I think you want to be aware that there's a possibility that is already well built into the market, and the possibility that it's actually negative, because that probably takes away the chance, if they do cut the rates, probably takes away the chance that there'll be another rate cut in January, which could cause the market to soften. If you look at the daily bar, it's almost a perfect trend line in there. Very narrow range. When I see that very narrow range, that is an indication to me that most of the buying is being done by very short-term day time frame traders. Anytime I see that, that is a very high risk situation to me. We had an excess high on Friday. Whether we get downside carry through or not, I don't know. But I want to go next to the daily bar, or to the daily profiles. And if you look at the daily profile, you will see that Friday's low was exactly at the settle. Additionally, the afternoon pullback low was exactly at the settle. When you see markets trade to exact references, that usually is an indication that the buying that takes place there is by the weakest of traders. Longer term money doesn't buy at those levels. So it's a very short report, but we're coming into to next week. I think the market will be highly focused on the FOMC meeting, but don't take it for granted that a rate cut is going to rally the market. It's already built in there. Additionally, this time of year, there is the potential for tax loss selling. While there's probably not a lot of losses, there are still some stocks that are down and some indices that are down. But you want to be sure that the tax loss selling doesn't take the market, put a little pressure on the market. Again, it's a very, very dangerous market for longs. Any trading that I am doing in here, I am using very tight references in there. And it's not the reference that I'm using so much, it's the fact that you're looking at pace. When the market rallied on Friday, there was just no follow through to the upside. That brought in liquidation. But as the market liquidated, there was no meaningful selling. All you got was liquidation of the early rally, but you didn't see any new money selling in there. Anyhow, that's the end of a very short report. I think so much is going to hinge on not so much the FOMC meeting, but the remarks that are made following the meeting. Have a great week. Thanks. Bye.